Okay, guys, give me 1 minute to corral the people in the office and we'll get started. We're gonna get started. Okay, guys. Becca, Nate, good to see you. We're not gonna wait for the other Zoom attendees to show up. We're gonna let them just plug in as they show up. So super excited today. Lynn and I love the cat malls. Love to have you guys. They were here doing, we were just talking about the energy when they did the vision board presentation. And it wasn't just because of Sean, it was because of our sponsors.
Oh, I know.
He was like bought in. You remember? Yeah. He scared you a little bit.
He did. Oh, yeah, I was like,
Did they plan
I
this?
don't quite, but I'm like, I'm actually kind of liking this. It's like he kind of like shocking us.
That's our AC.
Yeah, he's shocking us, like literally shocked and awe.
Yeah, that was quite an experience. So we are talking about building a business for first-time home buyers. Kind of a different scenario in this market, working with home buyers, right? Got to talk to them differently. So the lending company is their company. I was just talking to Stacy. They've got 20 LOs. They're getting, they're expanding into other states. Nate, they're coming to Oregon. Hey, Becca, where are you at? Can you hear? Can you unmute?
I'm in Utah.
Awesome. Good to see you.
Where in Utah?
I'm in Kaysville, Layton area.
Hey, I love seeing your
Hi.
face.
Awesome. Jesse's jumping on. Good to see you, Jesse. Okay, so Lynn, I have you up here with me.
Well, you said, let's go.
Let's go. Let's go.
Excited to watch my workout buddy. Yeah, I love Stacy and Sean. They have so much to bring to the table to teach you. And they have an incredible group of lenders that they work with, and they're selective. So they have the type of lenders you want to work with. So hopefully you learned something from today and
Absolutely guaranteed they will.
yes.
Yes.
Yeah.
So come on up, guys, whoever's gonna start. While you continue your introduction, I'm gonna share your screen so they can see your slides. And then I'll give you a little clicker here.
Perfect. All right, so I'm Stacy Catwell. It's nice to see you guys. There's definitely some new faces in here that I haven't met before. So I'm going to introduce myself and Sean a little bit later in the presentation. But I just kind of wanted to talk a little bit about how many of you are newer to the industry, less than a year. Okay, so quite a few of you. Okay, that's awesome. This will be good for you. And how many have been like less than 3 years? Okay, so most of them. So you guys are like the veterans today. Yeah. Okay, awesome. So I've been in the mortgage industry for about 7.5 years. And I started my business with a niche in first-time home buyers. And the reason that I did that, like, to be honest, there was no science behind it. It was that I was really scared to work with anybody else. I just didn't think that I knew enough, which some of you may feel that way, right? But first-time home buyers weren't necessarily like my friends. My kids were still, pretty young, so I didn't really have a lot of contacts there. But I just felt like first-time home buyers, I was a mom and I could help first-time home buyers. I just really felt like I could do that. And so that's why I started my niche with first-time home buyers. And lots of times, honestly, I've been like, dang, why didn't I start my niche with luxury? But I know, right? It's like, why didn't I do luxury? But honestly, now that I've been working with first-time home buyers, for the past 7 years, I'm starting to see a lot of return business, and I really feel like this is a great place to start your business, to build your business, and I'll go through some of the reasons why. So let's go ahead. Is this my clicker?
Yep.
Okay, awesome. Okay, so here's some facts about first-time home buyers, and I have a lot of I was like creating this last night, and I was just kind of in a weird mood, and so instead of putting like professional pictures of houses, I just put really stupid So, sorry about that, but that's what we've got today. So if you're bored with my presentation, enjoy things. So in 2021, 34% of home buyers were first time buyers. So this is actually the biggest segment of buyers, like all lumped together, right? And your typical age of a first time home buyer is actually 33 years old. So now here's the cool thing about first time home buyers. 73% interview only one real estate agent. So if you catch a first time home buyer, like when they're ready or when they're looking or when they're preparing, there is a really likely chance that they're going to use you for the transaction. Even if you're not super great at follow up, they'll still come back to you. And then 90% would use their agent again, which is where the opportunity really lies. Now, a lot of people say, I think the percentage of people anyway who say that they would use their agent again is pretty high. But I think it's like 90, I think it's like 78 or something percent say they would use their agent again, but actually like 20% actually do use their agent again, right? So, and that's because, like, honestly, because agents fail at keeping in touch with their clients. So first time home buyers, but if you get a first time home buyer, if you help them prepare to buy a home, and if you are able to stick with them and follow up with them and keep a good relationship with them, they will use you again. So Sean and I, we probably have about, I would say we have a 90% retention rate on our first time home buyers. Like every single one of them refinanced with us when rates went down, every one of them. When they are ready to purchase another home, most of the time they call us first. So we do a really, really, really good job in keeping in contact with our first time home buyers, even though our relationship with them isn't necessarily as strong as our agents. Our follow-up with them and our client retention management is really good. And so we're able to retain them. So now we're helping our first time home buyers buy second homes. We're helping them buy investment properties. And it's just, I mean, it's just deal over deal over deal, right? And if you look at the statistic that 90% would use their agent again, if you're looking for repeat buyers or if you're looking for luxury buyers, most of them have already used agents 1 or 2 or 3 or 4 times, right? So if you can get them when they're young and you can be first and then you follow up with them really well, you really just build a residual business for you for life, right? They just keep coming back. 87% of first-time home buyers finance their home purchase, which is really good for us. And what's interesting is that, like, the biggest obstacle for first-time home buyers is coming up with money for the down payment, but the actual average down payment is 7%. So while they say that that's an obstacle, I mean, 3% is what you have to have for a down payment. And so they're putting more down than they even need to. So people think it's an obstacle in our head. And I think sometimes we create it as an obstacle in our head, but for the most part, first-time home buyers they do have down payments. So let's go to the next slide. So let's just talk a little bit more about the opportunity. So first-time home buyers are younger millennials. So you have 18%, 23 to 31 are your first-time home buyers. And then your older millennials make up the extra 25%, and they're 32 to 41. But what's interesting is that, so they're the biggest group that are buying homes, right? But they're buying first-time homes, but also that second millennial group are buying the repeat homes. So those ages right there, 18 to 41, those are the ages that you really want to be working with. First-time home buyer activity as of March has held up more than repeat buyers in the uprate cycle. So as rates get higher, people who have options to buy, like if they're like, oh, I want to buy a second home, or maybe we want to move. What happens is they wait, right? They're like, oh, you know what, rates are high, I can wait till next year, or I can wait to do this, you know, in a few months or whatever. But first-time home buyers are they're more prone to, hey, the timing is right for me, we can afford a house, let's get into a house. And so even though rates are going up and it feels like affordability is coming down, first-time home buyers are still really active in the market. In fact, they're the most active out of any other demographic. So we have a large group of millennials who entered the job market in the mid-2000s, and now they're in their mid-30s. So the whole thing, I mean, you guys know, you guys have probably heard, right? Everybody's like worried that the market is going to crash. Well, the reason why the market is not going to crash is because the demographic of first-time home buyers is creating just such a huge demand. So back in 2008, we didn't have the large demographic of first-time home buyers. There was not that demand. We have the large demographic of first-time home buyers now, and that's what's going to keep the market moving and demand growing. So rents are becoming higher and higher. Maybe you guys have been talking to people who their rent has gone up. It's really rare now when we talk to people that their rent is lower than what their payment is going to be on their home, even with the rates going up. And also, like we already talked about, your first time home buyers, they are clients for life. So it's just like building a residual, it's a residual income. They just keep coming back over and over and over again, which is awesome. So let's just introduce ourselves. I'm Stacy Capel. This is my husband, Sean.
No.
Just sit down now.
I'm done.
Thank you.
More time this week to create a presentation, so that's why I'm talking to Sean, but you'll get to hear from him. He always finishes off with a bang, right, Jeff?
Yeah.
And then our son Jackson, he is our assistant and he's also a loan officer, and he actually works a lot with first time home buyers because he's in that age group. But loan officer is someone who solves a problem you didn't know you had in a way you don't understand. So we also like to call ourselves wizards or magicians, all that good stuff. One thing that's really important to know about us as the Capel team, other than we're awesome loan officers, we're great at building relationships, we're really, really good at what we do. We're brokers. So we work for our clients. It's one of the things that we love about our business. We've gone through lots of transitions with lots of different lenders. And in the end, we said, you know what, we're opening our own company. It's the lending company, and we're going to be broker. Because as a broker, we have the opportunity to take your deal and we can shop it with all the lenders that we're signed up with. So right now we have 36 different lenders. And so we're really able to work for the client instead of working for the bank, right? We're not working for our lender. We can do deals that other people can't do. We have interest rates that are lower. Our costs are lower. We don't have big overhead. We operate on super thin margins so that things are really, really good for our clients. It's something that's really important to us. So together we have about 12 years of mortgage industry experience, right? So I've been in for 7.5 years. Sean followed me over a couple of years later, and now we own the lending company. So that's a new thing this year. We're excited about it. It is kind of big too.
And when you pointed that out, when you announced the lending company, one thing I remember is the TLC.
That's right. So the reason we laughed, first of all, we were like shocked that the lending company was like actually available. We're like, what? Nobody's named their mortgage company, the lending company. But we love it, hey Mitch, because we have TLC, right? And so that's our acronym TLC, and we say it's Tender Lending Care. So cute. There you go. So what I want to do really quick, especially for some of you new realtors and some of you veterans too, because sometimes we don't really understand the basics of the loan, right? And we need to understand the basics of the loan in order to really understand our clientele and what it is that we are looking for. Because you can go out all day long and you can talk to people who say they want to buy a house. Like all day long, you can find them, right? But it's finding the ones who actually have the ability to buy the house and who are actually ready. So we're going to go ahead and go over just some really quick basics. And I talk really fast, so this is not going to be super boring. So here we have 4 different types of loans. We have conventional, and you can see conventional is like the winner of the loans, right? It's like first place. Everybody wants to be in a conventional loan. We have FHA loans, we have VA loans, and we also have USDA loans. So conventional loans are totally awesome because of one thing. And basically what it is it's mortgage insurance. So every single loan is backed by mortgage insurance unless you put 20% down on a conventional loan. Okay, and your mortgage insurance can be high or low, and it depends on your credit score, it depends on your debt to income ratio, it depends on a lot of different things. So with a conventional loan, you have an interest rate, and interest rates with conventional loans are not necessarily lower than an FHA, VA, or USDA. The big difference is that your mortgage insurance premium is lower. So this can save people $150, $200. I've even seen it save them $300 a month, right? On a conventional loan versus an FHA loan. So that's kind of the big thing about a conventional loan is that mortgage insurance. And then when you hit that 20% loan to value, that mortgage insurance, it drops off. And so their payment just goes down, which is awesome. Now with an FHA loan, FHA is the loan that most first-time home buyers use. And there's nothing wrong with an FHA loan, right? It's still a great loan. It's still a great opportunity. The reason why most first-time home buyers use it is because it allows them to have a little bit of a lower credit score. And it also allows them to be able to borrow a little bit more. So their debt can be a little bit higher, which a lot of first-time buyers, home buyers have those two obstacles, right? So the big thing with your FHA mortgage insurance is you have upfront mortgage insurance. So 1.75% of the home's value is automatically added to their loan when right when the loan closes. So it can be $6,000-7,000, right? That's added to their loan. So that's one of the reasons why people, want to be in conventional versus FHA. In addition to that, FHA, your mortgage insurance premium on a monthly basis is higher. So those are the two main loans that most people use. VA loans are awesome. If you guys are denying offers because people are giving you a VA loan, like, just don't do that. Like, respect our veterans. Most of them are excellent borrowers, but they have this awesome benefit that the government's given them that they totally deserve, and we should allow them to use it. The cool thing about a VA loan is that a veteran can come in with absolutely nothing down. We can use it to cover closing costs. We can use it to cover the down payment. I mean, it's just an amazing, amazing loan. So VA loans, don't ignore VA loans when they come in and when they're offered, because they're a really excellent loan for the people who have served our country. USDA loans are rural loans. And I have farmers here, so you can kind of remember that, but actually it's not really farm property. Like Saratoga Springs is completely eligible for USDA loans. But USDA loans are a little bit trickier because they are 100% financing, so you don't have a down payment, which is awesome. The mortgage insurance is usually a pretty good rate. The interest rate is usually pretty low. The problem with USDA loans is that your debt to income cannot be, like, really, we're looking around like 36% when we're closing a VA loan, versus we can go up to 56% on an FHA. So a lot of people don't actually qualify for USDA loans if you're looking at it for like a no down payment solution, right? If it happens to be that they just love that property and the USDA loan works, and that's great. But if you're like, oh, I don't want my clients to have a down payment, we're going to go look at all these USDA properties, a good majority of first-time home buyers don't qualify for USDA because their debt's too high. But if it's an option, then we'll let you know. Okay, so we qualify the borrower based off of 4 things. We do income, credit, assets, and employment. Okay, so income is the first thing that we always look at. We're looking at whether or not they are paid hourly or salary. Okay, if they're paid hourly or salary, the deal is usually pretty easy if they're working full-time. If they're working part-time jobs, it's not a slam dunk. Like, you can't think, oh, she's working part-time, she has income. It's not a slam dunk. We really need to look at the past year, and we need to see whether or not she has history at that part-time job. We need to see, what she's been paid or he's been paid in the past. So part-time jobs are not automatic income. So you can't even say to your client, oh, I'm working full-time, and now we'll just go get a part-time job, and then you can qualify for a loan. Like, it doesn't work that way, right? They want a lot of documentation on part-time income. So if your salary, slam dunk, super easy loan. We love, that's our niche, first-time home buyers with salaries. And you will have people, so there are loan officers out there who don't realize that, like, if you have, so commission, overtime, all that stuff, there has to be a history of it. So if you have a borrower who's just like commission only, or just changed a job and they're like half salary and now they're half commission, like I just had one the other day who all of a sudden they decided to change his pay plan. He's 1099 half now, and now he's W-2. Like, he can't do a loan. Like, you have to be 1099 for a year in order for that to work. But the big thing, there are a lot of loan officers out there who still think that like commissions and overtime and bonuses need a 2-year history, but you can actually close that with 1 year. So that's important for you to know. If your loan officer comes back to you and says, oh no, he makes commission income, we need a 2-year history, then you need to just, call up the lending company and talk to one of us, and we'll get your borrower approved. So self-employment right now, you guys, this new generation, like, I hope they just relook the whole guidelines, because the way people are making money now, you guys know, like, it's really changing, right? And so self-employment is really tricky because they do still really want that 2-year tax returns on self-employment. But I did just get a borrower through with on DU with 1 year tax returns. So just because they've only been in their business for like 1 or 2 years, it doesn't mean it's a totally dead deal. So talk to your loan officer, say, hey, you need to, will you run DU? Will you make sure that we can't get away with?
What's DU?
DU is called desktop underwriting. So basically what happens is we take a file, we put it all together, and then we run our desktop underwriting, and it basically underwrites a loan for us and says yes or no.
Through Fannie
Yeah,
Mae.
through Fannie Mae and Freddie Mac. So you honestly can know, I mean, when you're getting your pre-approvals, if your loan officers are running that, collecting documents, running desktop underwriting, you should never have a loan officer. Because we can know upfront everything that we need to do on a loan. So, so self-employment, like if you have somebody saying, no, we need 2 years self-employment, you don't always need 2 years. So there are some exceptions to that. Sometimes you can get an approval without it. So debt to income ratio, we kind of talked about this. What we do is we take all their monthly payments, and then we take that and we do a ratio with their gross income, right? So we take the monthly payments, we divide it by the gross income, and then we get this debt to income ratio. And you really want that to be like an excellent borrower is like 40%, right? But with FHA, we can go sometimes all the way up to 55% if their credit's good. So that's how we qualify on the income. When we're looking at credit, we can go all the way down to a 580 credit score on FHA. Now, usually if somebody has a 580 credit score, there's other problems, right? So it's pretty rare that we do a 580 credit score loan, but I mean, we can do them, right? You never know. Some people, people have, hard times and, and now they're making great income and everything else works and we're able to do that loan. Usually 580 to 680 credit score is an FHA loan because that's where the mortgage insurance and the rate makes sense and their payment is usually where it needs to be. 700 plus, we usually try to take conventional. But sometimes, like I have a borrower right now, she's 699, and her house, if we do an FHA appraisal on the house, it's not going to pass that appraisal. So we're going conventional. And her rate's a little bit higher, her payment's going to be a little bit higher, but we can actually get the loan done. So if you have an appraisal, or like a lot of times, like with condos and things like this, like you don't get that FHA, you don't have an FHA approved condo. That doesn't mean it's a dead deal. You can actually go conventional all the way down to 640 credit score. So if you're having those issues come up, just always ask, hey, is there any way we can take this conventional, right? And make it work. Because sometimes I saved a deal last year where that works. We're able to go
The
conventional.
loan officer was only the FHA.
Yeah.
And then we just switched it to conventional.
And it just worked. Yeah. So we can also do no credit score loans. So if you have a borrower that is not, like we have a cute borrower right now, she just never got credit. But she's they're making lots of money. She doesn't have a credit score. We can do no credit score loans as long as like they've been making some sort of payments, like if they've been paying utilities or they've been paying house payments or things like that. They don't necessarily have to wait. If they don't have a credit score, usually what we tell them to do is go get a credit card, charge like your gas on it, pay it off, charge, pay it off, charge, pay it off. And usually within 4 to 6 months, they're above 700 credit score. It's really easy to build a credit score. It just takes some time. So if they have a low credit score, one trick that you can tell them is, hey, if you're trying to build your credit, like if you have a parent, right, who has really great credit and has had like an American Express for 25 years, just add them as a secondary, yeah, on that credit card. They don't even have to have a credit card, but immediately their credit score will go up. So that's a good thing for low credit. We can do credit, we can do rescores, we can do, we can do what if scenarios. There's a lot of things that we can do to fix credit really, really quickly, especially if your borrower has cash. But sometimes they have to go into credit repair and they just have to wait it out. If their big problem is collections, a lot of times there's not anything you can do. You're just kind of stuck with that credit score. So in that case, instead of trying to improve credit, let's just get them in a house. You know what I mean? Let's get them in a house, improve their credit, and then we'll refinance them. So that's income credit. Employment, we need a 2-year. So with FHA, you have to have a 2-year history of employment and there can't be any gaps. So if you have somebody come to you and they're like, hey, yeah, I haven't been working, but I just started this job, and they have to go FHA. Like if they haven't been working for a year, they have to be back at their job for 6 months to a year, right? Like they can't just like go get a job. They have to show with FHA that they can hold down a job. With conventional, however, it's different. Conventional can have gaps. They just need like 2-year work history somewhere in their life, right? So say they were a teenager and they had a job, they got married and they, stayed home, took care of the family, and then they're coming back into the job market, maybe they've gotten a divorce. Like, we can still do a conventional loan because at some point in their life they had a job, or you can even use that homemaker. So I know, right? So conventional, it's so much looser because that credit score is high. They've proven that they can make those payments.
Also
So-
education.
Yes, and also education counts as a 2-year history, and also like for conventional, like missionary service, right? Like, because we have a lot of people who serve missions here. If they're out serving their church or are in the army or whatever, that all counts as employment history. So this next one says add transitions, animations, and motion, and then save to OneDrive to get your presentation. That is not supposed to be. But if you want to know, that
People may have questions about
yeah, I mean, there you go. Anyway, that's the big thing on the 2-year history, because we already talked about self-employment and we already talked about like part-time, right? So employment, we're looking for that. You kind of want a 2-year history. It's really strict with FHA, not so strict with conventional. So let's talk about assets. So on a conventional loan, you can have as little as a 3% down payment, which really isn't that much money, right? If they're buying a $300,000 house, like, it's under 10 grand. It's awesome. So that's really awesome. If you have, right now we're doing a lot of loans with non-occupant co-borrowers. So like a parent is co-signing. If you have a parent co-signing, they need 5% down. So we can't do the first time home buyer 3% down. FHA is 3.5% down. Funds all have to be sourced. It can't be, money. So if you're talking to somebody and they're like, oh yeah, I have all this money under my mattress, say get it in your bank account, like right now, before we even start looking. Usually they have to be sourced for 2 months. So, and then if they're talking about moving money around in their accounts, say stop right now, go talk to your loan officer. Gifts, you can use gifts from family members, and lots of first-time home buyers use gifts. And lots of first-time home buyers will tell you they don't have money for a down payment, but when you ask them if their parents will will help them with that, a lot of them say yes, right? They just don't think about it until you ask them. So I want to move on now to down payment assistance, because without fail, when people talk about first-time home, they're all like, what down payment assistance programs do you have, right? That's like the first thing. So I have some feelings about down payment assistance programs. Nothing is free, right? Nothing is free. So most of the time, if they're getting a grant or they're using a down payment assistance program, they're paying for it through the rates, and their payment is higher and it gives them lower purchasing power. So my advice to you, so when I started, kind of in the first time home buyer niche, I had all these realtors sending me referrals for down payment assistance. And a lot of the down payment assistance, now there is a place for down payment assistance. 100%. Like, I have a client right now that I'm working with, and there's just no way she is ever going to be able to get into a home without down payment assistance, right? But those are not the clients that I'm seeking out. I'm not advertising no down payment because honestly, a lot of them, for the majority, if those are the clients that you're going for, they're not going to qualify for the loan anyway. So you're doing all this work to build relationships with people who don't have down payments and to advertise to them and to market to them. But then when they go to get pre-approved, they don't have enough income, or they have too much debt, or like there's a reason why they haven't been able to save a down payment. So obviously when we have clients who come to us with who need down payment assistance, we help them, we get them into the best deal that we can. But my advice to you, as especially new realtors, don't make that your niche, no down payment people. Like, it's just really hard, and most of them aren't going to qualify. So let's talk really quick about Utah Housing. That's probably the most common down payment assistance program that people use. Pros of Utah Housing: you can get into a home with literally zero out of pocket. You don't need closing costs. In fact, I had somebody do a Utah Housing loan and they got $100 back at closing. So like, it's a really cool program for those people who really need it. Utah Housing loans, for the most part, are really easy and they're quick to close. It's just an FHA loan, and then at the end they take it through Utah Housing. So there's not like, a whole bunch of different lenders or people looking at it. Like, Utah Housing loans are they're really easy. The guidelines are really, really clear on them, so we know whether or not we can do them. In order to qualify for the best Utah housing programs, you have to be at a 660 credit score. There is one for 620, but the rate is almost a half a point higher. So you're really kind of, you know, so that's another thing, right? Because a lot of times our credit score is not high enough. So the cons is they have a lower purchasing power. So I did a calculation yesterday. So if you did a $400,000 or if you did a $475,000 loan, like purchase price, if they use Utah Housing, instead of qualifying for that 475, they would only qualify for 400. It's a $75,000 difference in purchase power because their payment is $400 higher. That's with the interest rate. And then Utah Housing actually uses a second mortgage to pay for their closing costs and their down payment. So you're talking about, so if you're just pushing clients to down payment assistance so that you can get deals, like, I mean, you're getting them into really expensive loans. Like I said, there's a place for down payment assistance, but don't use it to build your, you know, to build your pipeline because it really does hurt people. And the last couple of years we haven't, I mean, there hasn't been a lot of opportunity for Utah Housing or for down payment assistance because nobody wanted to accept those offers. But now we're coming back into a time where there is going to be an opportunity for those down payment assistance programs. But one thing that you have to remember is when, especially with Utah Housing, when you get them in, they are upside down in their house. They owe more than their house is worth. And likely they will not be able to refinance that payment for 2 to 3 years. So they are stuck in that loan with that high interest rate. And a lot of people who are using that down payment assistance, they can barely afford the payment that they're making. So just be like, if you guys want to do down, like we'll help you with them for sure. And if you have clients, but just be aware of that as you go out and you promote, you know, no down payment. Like it's not as glamorous as it seems. So there are grant programs. Community grants are awesome because community grants actually are free money. Community grants are just based on the city and what's left, right? Sometimes there's some left, sometimes there's not. Utah Housing has a really cool veteran grant right now, and they also have a really great police officer grant that gives them $25,000. So they aren't having to have that second mortgage, right? The second mortgage is what we call silent. And so they don't pay on the second mortgage. And then after, I think it's after 5 years, that silent second falls off. So lots of different ways to get people into homes with no down payment. But I guess what I'm emphasizing here is don't make that your priority because it's not always what's best for your client. Okay, so let's talk. So that's just kind of home, you know, loans 101. Does anybody have any questions about anything? That was, yeah, I mean, that was just really fast information, but it just kind of gives you an idea of what first-time home buyers are up against. Most of them have no clue what to do when they're buying a house. They don't have any idea, right? So like I talked to a cute little first-time home buyer yesterday. I'm like, hey, so what, like, where are you at in the process? What do you know? She's like, I literally know nothing. And she's 36 years old. You know what I mean? Like she's not young, right? And she can totally qualify for a house and she had no idea. And all this time she's been renting and she did not even know how easy it was to qualify for a house. So how to win first-time home buyers? Number 1 is educate. Number 2 is nurture. And then we're going to empower them, right? So educate. Like I said, most first-time home buyers have no idea how to qualify for a house. And most of them actually, when they kind of think they're ready, they start by looking at homes online. That's how most first-time home buyers start. And you guys have probably seen that. You guys have like websites and all that kind of stuff where people go on and browse and then you get leads. Well, that's really how most first-time home buyers come in contact with a realtor. Some of them, you know realtors or whatever, but most of the time they just start online. So what you want to do is you want to take the time to educate. And this is really, really important. And for us, we've done a lot of this through social media. Social media is, I mean, you guys millennials in here, millennials right here on the front. Yes, right. How do you get most of your information? Instagram, right? Through social media, right? So if you want to have a first-time homebuyer niche and you are not on social media, like just get on social media. And honestly, you'll feel like nobody's listening to you and nobody likes your stuff because it's super boring. But then all of a sudden somebody will message you and they'll be like, oh, hey, I wanted to talk to you about first-time homebuyers. So even though and people might not even listen to your videos, they might not even read it or whatever, but they know you're the first-time homebuyer person, right? So really focus on, and sometimes we have a hard time pigeonholing ourselves into like, this is what I do, right? I'm first time home buyers, because then we're like, well, what if nobody else calls me? Like, what if there's no luxury people that call me? That's really what I want to do. You know what I mean? But like, don't worry about it so much, because like I said, most of the time people aren't really reading what you post anyway. Like, nobody's really reading the long caption that you post. But if you take your niche, like I did, my first Instagram account was Your Mortgage Mama, because I was focusing on first time homebuyers, and I'm like, I'm a mom, like I'm going to take care of you the way that your mom would take care of you, you know, and that's kind of how I built my niche. And that's really how we treat our first time homebuyers. Like, I would never do anything to my first time homebuyers, or never get them into anything that I just wouldn't put my own kids into. It's really important to us to take care of them. So we do lots of social media for first time homebuyers. We also do first time homebuyer classes. And the key with first time homebuyer classes, what we found is that you just have to be consistent, right? Like, just set a date, like with second Tuesday every single month, and just do them every single month, whether it's through Zoom or in person. If you can do them in person, you're going to build really great relationships, and you will never lose those first time home buyers. Zoom, not as great, but it's a lot more convenient for people now, right? COVID kind of changed everything. But even if you have one first time home buyer show up for that meeting, it's worth it. Like, your first time home buyers classes, they don't have to have 30 people at them, right? You can have one, you can have two, and then you get to focus on them. You can do your, work with your lender. You can do the pre-approval right there, see where they're at, and build really strong relationships. But just being really consistent with those first time home buyer seminars is really, really important. And then also one-on-one appointments. Our son Jackson does this really well, because he has friends who are his age that are looking, kind of getting into the home buyer market. And so he'll just call a friend and just say, hey, you know what? Let's go to lunch. I want to take you to lunch. And, do you have any interest in buying a home eventually? Right? Eventually. Yeah, I totally do. Well, let me just kind of talk to you about it and tell you what's going on. Right? And so then he'll just kind of set them up and then help them make a plan. So a lot of first time home buyer stuff is not immediate stuff. It's long term, nurturing and taking care of them. Which takes us to the next one, is to be patient. So always when we're talking to first time home buyers, because a lot of them get really discouraged when we're qualifying them, if you just say, oh, sorry, you don't qualify, call me in 6 months, you know what I mean? And so whenever I go into a first time home buyer discussion, it's always like, hey, let's just talk, like, let's just make a plan. Like, whether you're ready or not, like, it doesn't matter, but let's just look at where you're at and let's make a plan so that you can be ready in the future. And they're so thankful for that, and they're so open to it. So just be really patient about it. Put them into your client retention management system and just keep following up with them. And if you don't forget about them, then they will eventually be ready and they're going to come back to you. So you might be building your pipeline. I mean, I've got first time home buyers I've been working with for 2 years, and they're still just getting ready, but it's all future deals. And we're not in this, for the short term, right? We're in it for the long run. So be patient with your first time home buyers, work with them. Also, like I said, work with your lender to help them prepare and keep them active in your CRM. A lot of realtors I found, they send me a first time home buyer when I say they don't qualify. They just, okay, let me know when they qualify. You know what I mean? Don't do that. Like, just take care, invite them to your client appreciation events, include them, even if you're just emailing them or texting them every few months, like, just see how they're doing. Like, this first time home buyer that we have, who I said we've been working with for 4 years, like, just this morning I sent her a text, hey, I'm so excited for you. Like, how's everything going? And like, we're just friends, you know what I mean? But when she eventually, is able to buy, well, she actually is able to buy a house. I don't know why they haven't, but they, they're going to come back to us, right? Because I've now built this good relationship with her for 4 years. So just nurture them, take good care of them. And then empower. So give them the means to achieve their goals. So if you nurture and educate, empowerment is going to just come naturally. They're going to have the tools they need. They're going to know where their credit score needs to be. They're going to know, where their down payment needs to be. Like, they're going to be saving. They're going to be on track. They're going to have a plan. And when they have the tools, then they'll feel empowered to go out and to buy that home. So a lot of this is working closely with your lender, right? Because a lot of this stuff is lender stuff. So just make sure that whichever lender you choose, that they're willing to be in it for the long haul with you. So here I'm going to now turn the time over to Sean. He's the fun one. So I wanted to, actually, I'm going to talk about a couple things first. So some strategies you might not have thought about to attract first-time homebuyers. So niche markets, right? So right now, there is a group of kids who are making a lot of money and they don't know what to do with it. Does anybody know what group of millennials that is? Who are those people? Does anybody
Especially
know?
right here in Utah.
Right here in Utah. They leave for the summer and they come home and they have thousands of dollars and then they go buy.
But their income is complicated.
Yeah, so anyway,
Yeah.
so
Planning is needed.
they go and they make all this money. They come home with $100,000 in their bank account. And they're like, well, these are solar. So these are solar. They sell pest control, they sell alarm systems. So they leave and they come back after the summer. They have like 100,000.
Thousands. of
Yes, so many kids. Anyway,
kids.
so
Most of them entrepreneurs.
they are entrepreneurs, right? And so instead of and the thing about these kids is they don't live here most of the year. Like they're selling solar and doing their thing, right? So they are like if you go to them and be like, it's time to, put down roots, you have all this money, you should buy a house and, get started with your future. That's not how you talk to these kids. You talk to these kids as investors. Hey, you have all this money, you should buy a house, get 5 other kids to live in the house with you and pay for it. And
while you're gone.
and we
It's
have a
still-
whole
still-
niche of kids who are doing that. And so come September, all these kids have this money. They need to know how to file their tax returns in January to pay for houses. And so we go in, we do first time home buyer seminars, but we call them their investor seminars, right? And then we teach them what their tax returns need to look like in order for them to qualify. And then we teach them how to use that money to build investment properties. And we have tons of kids doing that, like tons. They're super excited about it. And then they tell their friends and they tell their friends. And before you know it, the whole solar company is buying houses. So that's a niche that you might want to look at. The other thing is just even like corporations now. Corporations are back. A lot of them are back to work and they're looking for ways to add value so that their people want to be at work, right? And so reaching out to different corporations who have that demographic of first-time home buyers and asking if you can come in and bring in lunch and do a first-time home buyer seminar. Really great way to get in front of young professionals, right? Because really when you're looking at first-time home buyers, you're looking for professional people. Those are the ones that are going to be the easiest to get under contract. They're the ones with good income. And they're the ones who are really ready to go. So that's another thing you could do. If you're talking to first-time home buyers and they're worried about interest rates and being able to afford their payment, have you guys heard about have you heard of a 2-1 buy down? So the 2-1 buy down is something that's really big right now, where the seller will they basically pay the interest for the first 2 years, so that the first year they can have a rate 2 points below the going rate today, and then a point. So that's kind of a good thing right now because they realize, oh, I can afford it, and then hopefully I'm going to have the chance to refinance. But they are qualified off of that higher rate, so it's not going to help them qualify. But also using seller paid closing costs to actually just buy down the rate, right? Because sometimes you get these kids or you get people into homes and you're like, oh, you can refinance, and then they screw up their finances and they can't refinance. And so then they're just stuck with that high interest rate. So anytime you have a chance to, have a seller pay to buy down the interest rate, that's good. So Sean's going to just talk a little bit about, so we're parents, right? We're parents of like college kids and stuff like that. So this is something that we think about a lot, how to pay for your freaking kids to go to college. And we're just going to talk about a strategy that we've been using to market to parents of first-time home buyers and to help them get into homes.
I have a question.
Yeah.
So, I have to. So, assistance.
Yeah.
1,005.
Yeah, so if you have a borrower or if you have a client who can afford $475, if they use a down payment assistance program, the rate is higher and they also have a second mortgage. And so that increases their payment by $400. So instead of $475, they're only going to qualify for $400,000. Yeah, that's like their cap. Yep. So they have less purchasing power when you're using the down payment assistance.
Yeah, the income goes up, so then now the purchase price, power goes down.
It's similar to them buying a property with an HOA. They're increasing their debt,
Yeah.
right? So they're increasing their debt, so it lowers the
It's like-
qualification.
Be aware of.
Yeah.
If your borrower is qualified and they have a $300 HOA, check with your loan officer before you
Yes.
write an offer.
We're under contract.
I know.
That is big, that is big.
That's a big deal.
It's like, hey, need to know, definitely. You know, and I mean, I wish I would have met someone like Stacy when I was 23 years old, you know, hey, teach me. Teach me, like, should I be buying a house or renting for 4 or 5 years, you know?
We did everything wrong.
Yeah, we did everything wrong.
We didn't use it, we built, we didn't use a
Yeah.
realtor,
Yeah, yeah.
our loan officer.
We built a huge home right at the beginning,
Yeah,
you know,
wait, our loan
it's
officer.
like we could have bought 3 or 4 homes
Yeah.
in the process. All the things that you learn through the process, but you know, the thing is we don't have to pass this on to your kids and their kids and their kids and their kids, like our parents did with us. It's like, how much, you know, did you learn from your parents about real estate?
Nothing.
It's like, I mean, a lot of people, maybe some people did, you know, and they're that much further ahead, right? Or at least they're prepared to go and do things because they learned it from their parents. But in most scenarios, like my parents lived in the same house that they live in right now, the first house they bought, they still live in the same house. And so they, you know, I had no idea, you know, well, when should I buy a house? I have no idea. We bought our first house, I was making $20,000 a month. It's like, oh, can I buy a house? Yeah, you should have bought a house a long freaking time ago. And but I think here's an example. And I kind of wrote this down, just some notes. And I just want to give you an example of what you can do. So a lot of you have clients that are older, that have kids now starting to go to college, you know, a lot of these pest control, you know, whatever the case may be. People are like, yeah, we want to do something. And their parents are thinking about what? Retirement. Like, how do I retire? And Stacy talked about a little bit about education and a plan that we have, and it doesn't include the government paying off all your education. Like nothing's free, and we're going to end up paying for that. Okay. But what it does is taking responsibility and control of your own future. And one way is going to your kids and saying, hey, if you guys want to participate, we can invest together. And maybe this can pay off your education in the process. But if you're willing to buy a house with me and manage it with a bunch of people in different rooms, as you go to college, whether it be BYU or, you know, Utah or Utah State, we can actually make money and pay for your education, and it may end up really good in the next 4 years. Would you be open to that? And I think a lot of times, let me just kind of break down this example. So we have our boy. He came back from a mission, and he decided, okay, I'm going to go to what is it, UVU, and so we were looking at a property down in Utah. We had a 1031 exchange, and we thought, okay, let's buy an investment property. Well, let's buy an investment property that he can live in and then manage. And we'll rent out all the other rooms, right? So here's an example. So I may have to increase the size here, but okay. So we bought a property in 2020 for $660,000. That was a 5-bedroom, 2-bath, 2-kitchen, fully renovated duplex, about 4 blocks from BYU. And so really great location. We thought we were getting totally ripped off, you know, because somebody had just bought it and renovated it, bought it for like $400,000 three or 4 years previous. So we're like, dang, man. But either way, it penciled, you know, it's just fine. So we're going to take the 32% down that we had on a 1031 exchange, and we put it down on this property. Our payment on that property was $2,247. Our rents are $3,950. And so we were like, hey, we're making money. So and then Jackson's kind of just managing, you know, the rental perspective. But let me kind of give you a breakdown. So if we looked at this and we said, hey, Jackson actually stayed in school, which he didn't. But it still works for us. And actually, he's pretty good. Not unlike our child in Utah, that we're $30,000 in debt, you know, we paid out in cash, right? For her education, and she's renting right now for $700 a month in Salt Lake. So we should have done it there also in 2020, right? Take less 1031 exchange. We should have bought 2 properties and had 2 children and two homes, right? But let's just say this example. You go to somebody that's has money, has children, potentially they're a first-time homeowner down the road. But let's just look at this option. So my costs on this I'm estimating over 4 years is about $14,000 worth of repair, management, and upgrade, things that I do to the property. My mortgage payments are $159,000, close to $160,000 over 4 years. My rents are $189,600. And so if I look at this, I'm making $16,000 over a span of 4 years. $16,000, and my child is rent-free while they're going to college. Okay, so how many people believe that their child is actually paying for rent when they send them to college? No, that's a cost to the parent, right? Overwhelming cost, in addition to the books and the everything else, you know. And then the government gives the child $10,000. That doesn't make sense to me, but nothing does. But in this scenario, $16,000 worth of profit. But also, let's look at the equity. What if we sold this house in 4 years, in partnership with the son, you know, at college for 4 years? We bought it at $660. Let's say the current value right now is $800,000 on that house, with the increase over the last couple of years. But let's just say the increase only is only 5% in 2023, 5% increase. Then the value of that house would be around I calculated somewhere around $860,000. And so if we chose to sell this property in 4 years, we'd make $180,000 in equity.
Nice.
In profit, in addition to the $16,000 in rents. And so does this make sense at all?
Yeah.
To talk to people that are sending kids now to school, not just from the standpoint of like, what a drag on, like, I mean, I'm not saying our daughter is a drag. That's really lame. But I'm telling you that it's like, dude, like, literally, that's literally very expensive. And we were making a ton of money during those years. It would really be overwhelming to us. But it doesn't need to be. Okay, so let's look at the options. So in addition to the $180,000 in equity, you made $16,000 worth of profit. And that's if we sell it. What if we just stay in the thing? Or hey, let's now rent out that extra room. And here's some options. So what can that, what can this pay for? Okay, number one, student debt. We pay for all the student cost, everything, all their whole education is paid for. A down payment on the student's first home, 20% down, not 3% down. Okay, wedding expense. What if they're freaking marrying out? That's the worst case scenario. You're not freaking paid $40,000-$50,000 in school. Now you're a house mom, and you're freaking married a guy that's making $12 an hour. You know, now I'm gonna have to pay for everything. So, but either way, so and they're having a wedding, right? But it's like all these costs, right? It's a burden, right? But what if you can take that burden to something that's positive? Okay, 5 kids, $200,000. That's $1 million in your investment account. Take that $1 million, go buy $4 million worth of property. I mean, think about that. That's something you got to talk about to these people that are thinking, dang, I'm going to lose a ton of money. I'm going to take all this money out of my 401k and pay for my kids' schooling, right? Other things that could be good is if they want to go on and do a master's or a continued education. For me personally, I'm like, hey, that's on you. Like you go do that on your own. But if you would say, hey, listen, I want to help pay for that, you can, because you just made $200,000. Or you have continued rent in the house that's paying for those expenses. Other things would be a great start to a business. Maybe they just look at that and they go, man, I'm done with school, but holy crap, man. Mom and dad, let me do this with you. Why don't we just keep on buying? Why don't I buy the next house? We rent that out. And then every year we just keep on buying homes. And what I'm talking about here is this, something that we were not given at our age. I'm sorry, but it's like we were not given that option. But if we were given that option, we'd be sitting on $20 million worth of property right now with no current concerns in life at all. It's over. We wouldn't have to talk about retirement. It would be over for all of us. And I think what we do is we just owe it to our family, our kids to pass this on. Don't say, hey, well, crap, man, I'm too old. This is not going to happen to me. I give up. I'm just going to retire on a small little pension and I'm teed off. Or you can just say, you know what? I've learned what I've learned. And you know what? That doesn't have to change. Things can change. You can teach your kids what you know, and they can be better off by the time they're 30, 40 years old. They're totally retired. And what is that for their kids and their kids? You can change everything in your family.
The other thing that's cool about that strategy is
Yeah.
that, if your kid is living in that house, you can buy it as a primary residence instead of investment property. So you don't have to put 25% down, you can put 5% down.
So that's one of our biggest
Use your
mistakes,
kids
right?
to make money.
That's actually one of our biggest mistakes is really in 2020, what should have we have done?
Well, we should have bought that.
Take the $250,000, we could have bought 3 homes with 3 kids that are 18 years old as primary residents with 3% down.
Awesome. Anyway, if your friends have enough money to pay for their kids' college, they have enough money to buy. Yeah. A property.
Oh, yeah, for sure. Yeah.
All right, thanks, you guys. That's it.
That was awesome. I mean, that's kind of our jobs. I mean, some of you are new agents, but giving your clients options. You need to think about it and share this kind of stuff. You're talking about parents not sharing it with their kids,
Yeah.
but you need to share it with the parents so that they can't share it with their kids.
Right.
Correct.
Right?
And and they probably would be open to it.
Yeah.
Let me show you how I can pay for it. You can pay for your kids.
Hey, mom and dad, you can pay for all this. Or here's an example.
Yeah, get the kids to go.
Or I can make you money. How about I can do a bunch of freaking money?
Just take Sean.
Like, make me money.
Yeah.
Make me money.
But there's truth to that though, because it starts with the lender. Because they don't know what they can do. I say all the time, you don't know what you don't know. So you're explaining the concept to them and they're like, that sounds good in theory, but if they've never done it before, they talk to a lender and say, hey, based on your finances, based on your credit, this is a program that you can actually follow. Now they've got validation that they can actually do it. Okay, awesome. Okay, stay on here. Jesse, we got a sponsor. Josh is over there on the stairs. Brought us lunch. Yeah. Josh is with us, welcome back home warranty. We love Josh. One of the things that's most important for me with the home warranty is the rent that you're dealing with to kind of help you through the process when those issues arise. So Josh, introduce yourself, tell them what you can do to help.
Okay, awesome. Appreciate you guys letting me be here. I've been here a few times. Mitch made a good comment. I just need to have more kids now, so. I just had one a month ago. I'm like, no, we need to add any more.
Hey, kids. What it can be.
I mean, you have to convince my wife. She's the one that has to carry the baby, so. But anyway, so, yeah, so usually I sit here and I tell you facts, talk to you about the home warranty. I've been here a few times, so I don't want to necessarily bore you guys with details. I'm happy to hop on a call with you, but many of you use us, some of you don't, so I'm going to ask a few facts. I've got sweet gift cards, so you guys can grab a drink for who answers correctly. Who knows what we give each client whenever they close, what they get for free with our plans? Anybody? There you go. There's a gift card for you, a free rekey. Yeah, so it's included in our top plan. A rekey, yes, we rekey their homes for free with our $400 and $500 plans. We have coupons for that. It's included in our $600 plan. We feel that's really important. I don't know if you guys have seen the news. There's been sellers that have tried to break you back into homes. We've had that happen with some of our clients, and they're very grateful that we rekey their home. It's absolutely free to them. So not only is that like a great service, it's part of our model. We're built on the long-term play where we want them to renew. And they don't renew if they never use the policy. So we incentivize them to use the rekey. We also feel it's really important for homeowners when they're moving into a home to get their house rekeyed. Besides buyer policies, what is another type of policy that we offer to homeowners? Seller policy, yes, there you go. So we offer free listing coverage for the duration of the listing period. It's free to your clients. We have a PDF that we can co-brand for you. It's great for your listing presentations. It's an extra value add for them to hire you because you work with us, and we can easily transfer that to the buyer on the back end. We also do new construction policies. So we cover years 2 through 4. Builder does year 1. So awesome option there. One more question. Let's see here. Who knows my phone number? Anybody have my phone number? I know one guy that might win this card here. You can win this.
I like to share.
I know your name, Josh.
It is. We're gonna get a winner here pretty soon, and then everybody's gonna write this. 839-838. There you go. There's another card. You guys got super nice. You're going out for drinks later.
Yeah.
I like it. So it's 801-839-8386 is my cell phone number. Give me a call. I'd love to chat with you, interact with you guys after this. Not only do the home warranties, but we feel like as a vendor, we need to give back. I'll take you to lunch. I'll do all that. We can go golfing. But I also door knock with agents. We have CE classes where we talk about mindset habits. We also talk about social media, how to do advertising. So we really feel it's important to not just take as a vendor, but really give back and impact your bottom line, because as you grow, we grow, and we feel that that's really important. So you go to Park City. We do, yeah. So we cover the entire state of Utah up to the Idaho border, down to St. George. So no matter where you're doing a property here in Utah, there's some tiny cabin remote areas that we'd say, hey, you know, we really want to give an A+ experience, so maybe we'll hold off on that policy, but give me a call. I'm happy to chat with you about that. And I'll end. I've started ending my presentations with a thought. If any of you have read the Atomic Habits book, it's phenomenal. And one thing that I really liked in reading that was, you don't rise to the level of your goals, but you fall to the level of your systems. So as agents, not just in your business, but in your personal life, the more you can systematize things, the more you can make it easy and exciting, the more success you're going to have. If in your relationship, you know, we need to do date night, that's really going to help us. Okay, we'll schedule it every Wednesday night, every Friday night. It doesn't have to be Friday night, it could be a Wednesday. But whether it's your relationships, business, any part of your life, make sure that your systems are there, because that's what's going to sustain you. Because your goals are exciting, but if you don't build out how you're going to do it on a daily basis, it's never going to happen. So appreciate you guys being here. I'll bring up food here in just a second, and I've got flyers and stuff like that. I will leave them by the plates. So you guys can grab them. Did you have a question?
I just say Michelle and I use Josh, and he really goes with that for our clients. I don't even know the customer service phone number. I don't have to call anyone else.
Well, I can give you that one too, so you guys don't all call me. No, I'm just kidding. Yeah, exactly. No,
All right.
no, you're good.
And we also use Josh's flyer in our listing packet. So when you talk to a seller and you tell them that you have a relationship with Josh, go back and actually get free coverage during the listing. something happens, which never does, you know, it's really rare during that short time.
Right, yeah.
Yeah, so it's really great.
Yeah, it's been great the last year, 3 days listed.
Right, you're adding value to your.
Right, and to his point, with systems, you know, whenever you put in a listing order with us, your client gets an email with the information and says, congrats, you have free listing coverage because you listed with Jeff. So it's another way to make you look good in front of your clients. And then on the buyer side, kind of part of our system, they get their information, but we also do a welcome call a week after closing to make sure they know who we are, how to get a hold of us, what the policy covers, what it doesn't cover, so that we have the right expectations with clients. And we feel that's important because, again, our business is a long-term play. We want people to put claims in year 1, so then they'll renew year 2.
That's huge. I don't know anybody else that does that.
Nope, they say they do, but they don't actually. Yeah, that was one thing whenever we started the company, we called about 100 agents to find out what they liked and didn't like about home warranties. And that was one thing, the clients didn't even know who their home warranty was, so from the beginning, we put in that welcome call to make sure that they knew who we were, so. Yeah, appreciate it, guys.
Thanks, Josh. Hey, guys, I think that Josh brought us some lunch. We're gonna take a little break here for a second. Hey, Jesse, is Becca jumping back on?
Can we do a selfie real quick with everybody?
Yes, hey, Stacy and Sean want to get a picture. Got it. They wanna go up? Yeah.
Okay. For a little shoot back there, well done, good job. I love this.
Awesome. Thanks, guys. I love this crazy. Hey, Jess, is Becca
Hey.
jumping back on?
So I messaged her to see, because I know she was planning on staying the whole time, so I'm not sure where she went.
Okay, I don't know how. And so, you know, just take the watch, you know, they're a great situation.